Devina Mehra, Chairperson and Chief Investment Officer with First Global joins us now. Devina, good morning. Thank you for joining us. It's getting bad to hard and hard to worse. Are we reaching that point of maximum pessimism?
Good morning, Nikunj. You are sounding more downbeat than I remember you sounding ever.
No,
Uh,
I'm optimistic. It's just the screen is telling me that it's not looking great. So on behalf of for those who've suffered in the stock market, perhaps I wanted to get emotion in that question.
Nice cover up, Nikunj.
so, I mean, are we at the end of the fall? Probably not. But I mean, in terms of where India is, I don't think there's a huge amount of downside. I mean, as we sit here today, unless there are fresh developments. And as I have said earlier, also on your shows, that this year India at least will be an outperformer. That's the way if I look at the globe, partly because it was an underperformer for many, many years, except for 2021. So 2021 was the first time India became a significant outperformer among the major markets. It was number 6. Prior to that, many years, it was like number 20, 24, 19, 25, like that. So that's the good news. But obviously, I mean, global equities overall don't look great as of now. And the other part is that unlike last year when it was the tide lifting all boats kind of market, this year you have to be more selective, more nimble also. So I mean, both in terms of sectors and even within sectors, you have to drill down to company levels as to what is happening and be more selective. And as I said, you might need to change tactics also midway. So that's the way this game is being played out.
Markets always, and let the optimistic Nikunj come back. Markets always climb the wall of worry, which is that they peak out when they peak out at the peak of bad news. How much of the bad news is in the price now?
I don't think, as I said, I don't think, the pain is completely over if you look at the market as a whole. But then, as I said, you have to really look at it on a more granular manner because things change. I mean, a month and a half ago, all commodities were up. Now, because China went into this lockdown mode and cut back and there has been therefore a significant drop in demand, many commodities, metals, for instance, almost all metals have given up all the gains they had. And you are now below the December ending levels for most of them, both precious metals and others. I mean, it was barring, I think, iron ore is still up for the year. So that's why I said that because there is so much news flow and always life is only about probabilities. You have to keep watching. I mean, Fed, for instance, wouldn't know sitting here today what its terminal rate is going to be because it also has to watch out how things actually play out. So it's very difficult to make a prediction, let's say, for a year today because things are very, very dynamic. We are dealing, if not with unprecedented things, but on the macros, you are where you have not been for decades. For the first time in decades, the Western central banks have inflation to target, which was always a background variable for them because it never came to a situation where it was way out of their target rates. If you look at India also, many variables which one has to watch. So as I said, even the central banks wouldn't know where they will be 6 months later or 8 months later.
But Devina, tell me, given that India has fallen a lot less than the US markets, can this relative outperformance of India continue when you are anticipating more pain, when economies like US are talking about the big R word, recession?
So as I said, I mean, again, that's what the US is not looking as good as India is currently. I mean, as I said, as we sit today, it looks like India will continue to outperform because it has come out of a period of a very long underperformance. And as far as the US recession is concerned, one will have to watch whether the Fed lets it go to that situation, because as of now, of course, on the unemployment front, things are very, very buoyant. I mean, or rather on the labor market front, things are very, very buoyant in the US. You still have, the last number I saw was 2 vacancies for every unemployed person in the labor force. So that's still a big gap to bridge. So that is what Fed is thinking, that there is that cushion. That, but of course, there's been that huge amount of liquidity pumping over this whole COVID period. So as that gets withdrawn, there would be some pain. So let's see where sort of it's a game of chicken. So where the markets and where the Fed stops.
Indeed.
What has happened, of course, in the US is that you had this situation where fixed income was also going down pretty dramatically. I mean, I think fixed income was indices in the US were down about 8% for the year, but now that part seems to be halting a bit. So I mean, in the year to date, there has been, if you look at global markets, almost no asset class, barring commodities, where you could hide. And there too, as I said, part of the commodity bunch, like the metals, have also given up their gains. Otherwise, fixed income down, developed markets down, emerging markets down. There were like only 4 or 5 markets in the entire world which were up, and most of them were commodity plays like Saudi Arabia or in this region, plus an odd Australia or South Africa. So just there's been virtually no place to hide in global assets.
Is there place to hide though when it comes to India though, Devina? We may have relatively fallen lesser than our global counterparts, but we've fallen regardless and pretty much across the board.
Right. So what we think are the outperforming sectors, 2 themes which I've spoken about in the past also. One is rupee depreciation, which has been our base case for this year, much before the Ukraine conflict, in fact, much before even the year began. Since last Diwali, I've been saying that 2022, I see the big risk as rupee depreciation. So, and of course, on the positive side, you have things like PLI. So, I mean, our outperformer basket or slightly overweight basket continues to have IT services, though they haven't done so well this year. They were huge outperformers for a year and a half before that. There is capital goods, which came out of a long funk. There has been textiles, some parts in telecom and oil and gas, some parts in chemicals. So as I said, even in a theme, you have to look at really little bit drill down, because chemicals, for instance, it depends on what is the degree of forward and backward integration, where in the cycle you are. So that would be broadly what we like at the moment.
Good morning, Devina. This is Nantara. So just continuing with that, and you said about rupee depreciation. You folks have been overweight on IT for a long time. I think since 2020, to the pandemic. But now, given the IT sector's underperformance, the blue chip fatigue, which is also seeming to set in, are you staying overweight?
Yeah, we are still somewhat overweight, Nantara, because we. As I said, that this is a more a long-term theme. Yes, you are right that since 2020 there was also a big, it was also an anti-FMCG bet at that time, because FMCGs were the flavor of the season, and or rather for that entire year. And we really thought that this is another sector where you have predictability, and you have reasonable margins, reasonable returns, not as high as FMCG, but still pretty good. But the valuations were a fraction. So some re-rating has happened. And as I myself said, that year to date, it has not been a great bet. But these cycles come. I mean, we still like, on the fundamental basis, we continue to like it, and more so on a relative basis. And as I said, our base case is rupee depreciation. So yes, we continue to remain somewhat overweight on the sector. We have looked at the employee cost and attrition question, and I think that thing is, we're past the peak in that or peak pain on the employee front, and so I think still. Given all that else is on offer, so both on the rupee depreciation front as well as the predictability front, it's a sector that we continue to like.
What about banks? Yes, we saw maybe SBI, take it on the chin 5% on Friday post the earnings missing street estimates. Do you think banks will be a safe bet and the best way to go? Because, as far as the macros go, investments, the capex cycle, which is changing, relatively insulated from Russia-Ukraine conflict.
Banks, in my book, are never a safe bet in that sense. That's always a risky sector. It's a highly leveraged sector, which is why rarely do I like it. And if you look at even last 2 years, 2020, it was the only major sector in the red in a market which was so buoyant. In 2021, while it was not in the red, it went up only half as much as the market. And as I was telling somebody, this is a sector where negative surprises are more than positive surprises always. And as an outsider, it's very difficult to know when and where those negative surprises will come. So all that aside, of course, we've had negligible weight in considering this is such a high weight sector in the indices. We had a negligible weight from 2020 and 2021. So from there, we have increased our weight, but we would still be somewhat underweight. So that's been our broad strategy on banks. Of course, the one positive for banks is that at least on their loan book, as interest rates go up, the margins go up because you reprice the loan book first. I mean, basically, you raise interest rates on the loans first, whereas on the deposits, it happens over a period of time. So to that extent, you get that cushion. Of course, on the other side, on your bond book, you take a hit because as interest rates go up, bond prices come down. So that's a little bit of a balancing thing for Indian banks. As I said, we are not as underweight as we used to be, but we are not overweight either.
Devina, the challenge is that when you are in this rising interest rate environment, if you sit on cash, that cash A is going to lose its value. B, whenever markets they reverse, you will not be able to catch the upturn. So what should be the ideal strategy in this kind of a market? If you don't raise cash, well, stock prices go down. And if you raise cash, then there are chances of when market turns, you'll not be able to catch.
Yeah, so what I'm recommending right now is that whatever you want to invest, maybe, split it over 2 months, 3 months, 4 months, and get your toes wet, so to say. So, and you are right that it's almost impossible to call the exact bottom and say from here now that is the exact time to get in. So this is like, I think we are in the range where you can start at least getting back in. And of course, we are holding slightly higher than normal cash in our portfolios and keeping the powder dry for any other thing that we see. So the cash is definitely on the higher side than normal.
Let's look at the bright side. And the bright side is that the bond yields have come down from 3.1% to sub 3%. Crude is definitely not going above $110. In your opening remarks, you refer to the fact that with the exception of iron ore and one more commodity, all commodities are down on a YTD basis. So while central bankers are worried about inflation at its peak, the internals are indicating that the reversal has already started. And will equity markets take confidence from that if demand is coming down, yield is coming down, metal prices are coming down, then perhaps inflation has peaked out?
So you have to look at it country by country. So I had done a piece on the March inflation numbers around the world, and I had said that in the US, I think inflation is close to peaking. Whereas in Europe, it was a different story. Europe, it was still on the way up. So you have to really look at it. Of course, in US also, it has not gone down in the April number as much as I thought it would, mainly because as mortgage rates are rising, people are just scrambling to buy the house and get them lock in today's mortgage rate. So that is what has been that's why what they call the shelter part of the inflation, which is the housing related inflation, has not come down yet. So, but I mean, I suppose that will play out pretty quickly. And as I was saying, that in fixed income, even I think the pain is somewhat behind you in as far as US is concerned. But US is a particular market because you also get safe haven flows into the US treasuries. So that is the other thing. That's why also the yields are, you said, have come down from the peak. So that is not something you can extrapolate to the rest of the world. Commodities, yes, because have come down mainly because China demand has come down in a few, and except for energy, the oil and gas part, other commodities have come down from the peak. Agri commodities again have not come down, which is relevant for India because if you look at the market as a whole, or for that matter, the economy as a whole, you have a situation where in the household budget, there is a lot of pressure because food has gone up, fuel has gone up. If you look at the last inflation CPI number, clothing is up by 10% year on year. And that is not surprising because cotton prices are up and petrochem prices are up, which are used to make synthetics. So there is like a lot of pressure on household budgets, which will weigh down demand for everything else. Because if you are paying more for essentials, you will try to postpone what you can, whether it is, whether it's a fancy face cream or shampoo, or whether it is a motorcycle purchase. So in India, for a large percentage of the population, there is still economic hurt, so to say. It is not there for the organized sector employees, which is why, in IT, you see that employees have been getting more, and so also more or less across the organized sector. But below that, there has been a lot of pain. So which will be a demand drag for a lot of industries in India.
Makes sense. Okay. Always great having you on the show, Devina. Good to speak with you.
Thanks for having me.